Welcome back, everyone. And I'm going to go over the Goldman Sachs housing market prediction for 2024 to 2027. Furthermore, I'm going to share with you we are the housing sales market is going back to the Stone Age. Yes, Stone Age. Okay. What do I mean by that? We're going to find out. So I got some very good information to share with you. And without further ado, let me dive in. All right. So I'm going to go over the U.S. existing home sales. Existing home sales in the U.S. declined 1.9% month over month to a seasonally adjusted annualized rate of 4.14 million units in April of 2024, the lowest rate in 3 months compared to an upwardly revised 4.22 million in March and forecast of 4.21. Further, home sales changed little overall, but the upper end market is experiencing a sizable gain due to more supply coming into the market. Upper end market, slightly in California, where I live in San Francisco Bay Area for the past 30 years. Yes, I have personally seen the upper end market here in the Bay Area. $1 million home is like an entry level. Okay, so when this article mentioned upper end market in the Bay Area, the upper end market will be $2 million house and up. Okay, a $2 million house is around 1,600 square foot, 3 bedroom, 2 bath, cookie cutter, a craftsman home built in 1940. All right, okay, and that's it. That's what you get in the Bay Area. Similarly, in Southern California, LA, Orange County, and in San Diego. Yeah, so I would say, in addition to California, the upper end market has more supply, definitely more transaction, not only in the expensive market in California. Similarly, with South Florida, Miami, Fort Lauderdale, the higher end market is also, of course, New York City Metro, Washington, D.C., Boston, Massachusetts, and certain parts of Chicago. And also Seattle. I keep forgetting Seattle, Pacific Northwest. The median price of a home is very expensive, in excess of 1 million. Because geographically, Seattle we're located in a deep corner of the Pacific Northwest. A lot of us just forget about them, right? Anyway, so let's go forward. So that's what the National Association of Realtor Chief Economist Lawrence Young, that's what he says, that the higher market is experiencing more sales than usual, and sizable gain because there's more supply. Further, we are at nationwide, we are at 3.5 months supply of inventory at the current sales pace, which is still we're still in low inventory environment nationwide, up from 3.2 months in March and 3 months in April 2023, year over year. Okay. So for home price, increased by 34 to 40%. Like I just mentioned earlier, on the more expensive markets. Let me see. There is a year-over-year increase of 5.7 in median sales price, which is a 10th consecutive annual gain and the highest price ever for the month of April, according to the National Association of Realtors. All right, there you go. I'm starting off with the existing home sale, which is still in a very low inventory environment. Further, according to Resi Club, this website, the headline is existing home sales recession hit so hard that we are back to 1978 levels. Wow, this is mind-boggling. Okay, this is just very unheard of. So where Goldman Sachs thinks existing home sales and new home sales will head through 2027. So, like I said, I'm going to talk about the housing forecast per Goldman Sachs. All right, so here's the issue, right? Again, why U.S. existing home sales we are back in the Stone Age, back to the late 1970 levels, okay? Which is really mind-boggling. This is just really amazing because back in April 1978, there were 4.09 million US existing home sales. Compared to April 2024, we're talking 22 years, 46 years, all right? 22 plus 24, 46 years. And the projected existing home sales for April 2024, 4.14 million. Even though in 1978, we only have 223 million US population, where by now, 2024, we have 341 million US population. I just want to really pause for a moment. We are such a unique housing market today. And the reason is, okay, drum roll please, housing affordability has deteriorated because of the skyrocketing home prices in the past 2 years during the pandemic and the elevated mortgage rates from the 3% mortgage rate on historical low back in 2021 all the way up to 8% in November of 2023, and now down to 7.02 mortgage rate today, 5th of June 2024, according to Mortgage News Daily. That is why we're calling housing affordability, historical housing affordability issue. We are entering a historic renters nation. More people will be renting than ever before as a result of everybody being priced out of the housing market nationwide. Okay? So many buyers and sellers are pulling back from the market because many homeowners who would otherwise like to sell and buy something else are staying put rather than trading their 3% historically low mortgage rate for a 7% mortgage rate. This is what we call a locked-in effect. Locked-in effect. People are not moving. Their low historical rate is an asset. It's not a liability. Does that make sense? So those people that refinance back in 2021, they have at least 27 more years of locking their mortgage rate. They are in mortgage prison in a good way. Okay, they have such a low mortgage payment, fixed rate mortgage. They're not gonna get rid of it because if they gonna try to move up to a 7% rate, they can't. In fact, a lot of them cannot even afford it because they have to pay more than twice the mortgage payment that they're paying right now. All right. Yep. Further, according to a forecast published this week by Goldman Sachs, the recovery for existing home sales could be a slog. You know what I mean by slog? A slog is that animal from Australia, the cute-looking slog that hanging by the tree, moving very slowly like a slow motion, a cute little animal. If you've ever been to Australia, I have not been to Australia, although I've been to 50 countries. 50 countries already. Australia would be on my radar very shortly. So I'm going to visit a slog. A slog is a slow-moving, cute animal just hanging by the tree, minding their own business for 10, 15 hours, not moving. That is similarly with the housing market. Housing market is moving very slowly due to the lock-in effect, due to the lack of transactions, due to the homeowners and buyers and sellers are just not, they're just sitting put, staying put. Okay, the next question is where Goldman Sachs expects U.S. existing home sales to go for 2024, this year, 2025, next year, 26 and 27. So the next 3.5 years, where is it going? If you look at the chart, the projection, I need my reading glass. The projection for existing home sales, 2024 this year, 4.1, next year, 4.2, 2026, 4.3, 2027, 4.5. Now you compare to the 2005, only this level of existing home sales only compared to around 08, 09, 2010, and 2011. Those 4 years are the aftermath of the housing crash, whereby the sales were very similarly low compared to the next 4 years. Every other year prior to the housing crash in 2008, and aftermath of the housing crash from 2012 onward, from 2012 all the way until currently, there are more sales occur. Just go show you the systematic decrease of housing supply of inventory. All right. Heading forward, Goldman Sachs expects the existing home sales to slowly drift up from 4.1 million this year to 4.5 million 4 years now. Further, not only is that far below the 6.1 million during the pandemic housing boom in 2021, it is also well below the 5.3 US existing home sales during normal times in 2019. We are experiencing a existing home sales recession. That's another buzzword that is coming into the housing market. Coming to the mainstream house market. Recession home sales. Wow. Okay. Well, this recession for existing home sales has coincided with the pricing corrections in some pandemic boom towns in parts of Texas, mainly Austin, right? And the Mountain West. Where's Mountain West? Mainly Boise, Idaho, perhaps Las Vegas and Phoenix, Arizona is close enough geographically to equate what this paragraph trying to say, Mountain West. Okay. While where many housing markets in the Northeast and Midwest, by the way, where inventory has remained tight, these regions have continued to see rising home prices. Wow, isn't that interesting? All right. Additionally, the U.S. new home sales market, let's talk about new home sales, new construction from the builders. Okay, let's switch over. And this is a very interesting paragraph. The new constructions have fared better, much better than the existing home sales market for two reasons. One, single-family home builders don't have a lock-in effect, right? That's obvious. They continue to develop and build new homes based on the perceived demand. That means the new builders, they're not going to overbuild. They build just enough to satisfy the current demand. Okay, they don't have a lock-in effect. Okay, they need to move their inventory. How they profit is like they build the new homes, they sell it quickly, and once their limited amount of new construction homes are absorbed into the current marketplace, they will obtain more land. They will do permitting. They will build the lots. They go through the whole building cycle. So they do a lot of builders, or the nationwide builders, national builders, and local builders all over the country. They have a very robust research team to monitor the new construction home sales from the consumers. And they use some consulting firms. One firm, coincidentally, the sources they use, one firm is something I use their sources too, is John Burns Consulting. They are the consultants to the building construction industry. So whatever. Okay. Home builders where needed have done affordability adjustments like outright home price cuts or mortgage rate buy down to quote unquote find the market. I just said that, right? Did I not just said that in a different way? And move product. Many sellers in the existing market have resisted the rules, right? Individual homeowners, they have a lock-in effect. They have a different mindset, okay? But builders, they have to move the inventory. One way to move it fast is they offer the mortgage rate buy down. They offer concessions, right? Instead of paying the ongoing mortgage rate 30-year fixed for a new buyer, they can do a buy down. They can buy down the rate using their own money, okay? They will decrease their profit margin. So they can buy down the rate all the way down to 5% or 4.25% 30-year fixed rate mortgage. So those are tremendous benefit that the builders are incentivizing consumers to buy their new construction. So that's why they can move inventory fairly quickly, because they don't have a lock-in effect. Is that right? So as I conclude this, where Goldman Sachs, so here's the forecast by Goldman Sachs for the next 3.5 years, as you can see. And the forecast is, here it is. Drum roll, please. Goldman Sachs thinks the average 30-year fixed rate will fall to 6.5% by the end of this year, 2024. And then for next year, 2025, they believe the rate will fall further to 6.3% by the end of next year, 2025. Further, an analyst at the investment bank, Goldman Sachs, forecast that U.S. home prices will rise 3.8% in 2024, and home appreciation will follow in 2025 with 4.4%. So at the end of the day, Goldman Sachs or any other national news media, they could be wrong. We don't know, right? No one have a crystal ball. Goldman Sachs, they do have some kind of credibility. So my takeaway is I do not foresee any housing crash, even though a lot of housing crash bros form. They keep on saying that every single year. They've been wrong. House crash bros, they've been wrong for the past 2 years and even longer. So because the fundamentals of real estate, supply and demand, when demand is greater than the limited supply, housing can put pressures on houses to go up. Further, a balanced market is 4 to 6 months, right? According to many sources, including Webster and a few other sources, the current month of supply of inventory nationwide is around 3.2. So we have still a very limited inventory environment, and demand is still out there. So there you go, fundamentals, right? So housing market is still very resilient, and for people to continue waiting in the sidelines for no apparent reason, people try to time the market, that's not the right thing to do, okay? So that's my takeaway. Too many people are sitting on the sidelines. The data just giving you a very verifiable, very concrete. There's really no housing crash, because the labor market is still very strong. Unemployment is still very low. Economy is very healthy. And so once the market is chugging along, and expect appreciation, albeit very moderately. So you risk by waiting at your peril, because by waiting, my philosophy is buy real estate and wait instead of wait to buy real estate. Okay, so anyway, that's my takeaway from this presentation. It's just housing market is still very resilient, and we should take action for those people that can afford it. They have a long-term buy and hold strategy. So anyway, if you see any value whatsoever from this video, please like and subscribe to my YouTube channel. And also, if you have not already done so, put your email at the bottom on my website, so you can become a free member of our real estate investment club, where you will receive weekly information on investment real estate, so you can become a well-informed potential real estate investor. All right, thank you so much for watching, and I will give you a lot of housing updates on many aspects of real estate. So thank you for watching. I will see you on the next video shortly. Have a nice day. This is Seewing Yee. Bye-bye.